Let us wrap the week. We have two pieces to today's show. We wrap the week first, and then we will go to our final bar mailbag here in a few moments. I want to start quickly with a poll. We asked all of you recently, which of these would you rather own over the next 3 months? Consumer discretionary, consumer staples, or cash? And the chart that I usually use actually comes from our Mindful Investor Live chart list, which we'll come back to here in a little bit. But to start off, let's go to the chart of consumer discretionary to consumer staples, which is this one right here. The reason why we wanted to pose this question to you is because really the relative performance of these two sectors has been relatively consistent. It's actually been fairly sideways. So these two sectors have been moving together. Now, if that surprises you, because the market overall has been obviously stronger from March to September, but the relative strength, the ratio of these two sectors is flat, it's because you have some of the larger names that have struggled. Tesla, Home Depot, Amazon are the three biggest stocks within consumer discretionary and consumer staples. You have some charts that are actually working okay, while you have plenty that are struggling, like Brown Forman and many others. You have charts like maybe some of the tobacco names that are bouncing up, things like Kroger and Costco, which we've talked about in long-term uptrends. So in the end, this nets out to a flat relative line. So 58% of you, in terms of the results, voted for consumer discretionary, only 24% consumer staples, only 18% opted to be in cash. If I were to vote, I would probably agree with the majority here and vote consumer discretionary. I think the time frame is key. If you ask me about the next month, I might say cash, which seems kind of crazy, but I wouldn't mind sitting out the seasonally weakest part of the year, the month of September, and assuming that I can get back in at a good level in a couple weeks. But overall, I'm gonna follow the trends, and I think consumer discretionary certainly has potential for further upside. At the bottom, you have the equal weighted version of those two, and you can see it continuing to push onward and ever upward. Let's continue on with our wrap the week segment. So what we like to do next is focus on the weekly change. So we're looking at this group of asset classes over the last 5 trading days, starting the clock last Friday and going to today. The S&P actually finished that stretch up 0.6% for the week, so sort of mildly bullish move to the overall week. 3 asset classes underperformed large cap stocks this week. Gold actually popped higher Thursday into Friday, so finished up 0.5% using the GLD. 2 of the asset classes were down on the week. The dollar index, which is here in green, was down 0.6%. In red, we have the worst performers, which are long bonds. Actually, the TLT, the bond ETF, which was down 0.7%. Everything else actually outperformed stocks this week. In purple, we have the IWM. This is the Russell 2000 ETF, up just a little bit more than the S&P. In brown, we have crude oil up 1.1%. In pink, the NASDAQ 100 up 1.5%. We now get to the big winners for the week. Bitcoin, which actually started the week relatively weak, but then reverted back to the upside. We've seen Bitcoin approach that 50,000 level, pushing above it in the last 24 hours, which is an impressive potential follow through, which is what I'll be looking at over the weekend, up 2.7%. The best performer, though, surprisingly enough, emerging markets. EM were up almost 3% this week. So the S&P up 0.6%, you have EM up 3%. We don't often get to the ratio of emerging markets to developed markets. It's on my Mindful Investor Live chart list. We usually get about halfway through that list of charts, by the way. We don't get through all the ratios that I like to review as part of my process. So I'd encourage you to copy that chart list to your own log, and you can go through some of those ratios, because you'll see that actually EM has really started to revert higher versus developed markets. EM has been a consistent underperformer. You're starting to see signs of life with the commodity complex starting to bounce higher this week. So maybe worth a look in some of those markets you may have been ignoring recently. Let's continue on and finish up our Wrap the Week segment. Look at the Mindful Investor Live chart list. This is a chart list that I maintain. You all have access to it as StockCharts members. I'd encourage you to check it out. The way to get to it, by the way, is go to the Articles tab at the very top of our StockCharts website. Go to my homepage, which is called The Mindful Investor. And at the very top, you see this little gray button that says Live Chart List. That will take you to this list of charts that we're looking at. Now you are welcome to copy them to your own login, save them, share them with your friends, do whatever you like with them. We start, as always, with the S&P market trend model. It's actually pretty interesting. The long-term model has been bullish for over a year now. Last June of 2020, a couple months after the major low in March of 2020, this long-term model turned positive and has remained incredibly positive through that entire period. Overall, still very much in a position of strength, which makes sense. The medium-term model, I spent a lot of time thinking about this week, because I'm noticing as the market continues higher, my medium-term market trend model has remained negative. And while I appreciate that, I very much have liked that because May is really when the bull market stopped for all the cyclical sectors, or most of them, right? Most of the names that led into May have come back and have retreated quite a bit. This is when the breadth conditions deteriorated. And so having the medium term model be negative really helped me to think about potential risk versus potential reward, particularly in some of those names, and to make sure that stops and lines in the sand were all updated. However, I can't help but notice that the markets continue to push higher. So visually, I would argue that the medium term trend is very positive, but the models actually remain negative. This is based purely on the weekly MACD, or the weekly PPO, which has remained negative. I think really because of the construction of that indicator using the signal line. So I'm looking to see if there may be a better way to measure the medium term trend that is able to follow the markets a little more effectively. Overall, I like the fact that it's made me think more about a potential risk. It's still net negative. It has not quite turned positive as of the close here on Friday. So medium term remains negative for my current model. The short term model has remained positive. It's only been a couple of weeks, maybe less than 5 weeks over the last 8 months, where the short term model has been positive to finish the week, which just speaks to the way that the weeks tend to end in a position of strength higher than the previous Friday. The chart of the S&P, I feel like in the last couple of days we've hit this pretty hard, so I don't mean to beat it over and over. I just would I've updated all of these levels with the lines in the sand that I think are key. One of the key important things to measure are just the highs and the lows, right? Are the highs getting higher, which they are yet again this week with new all-time highs? Are the lows getting lower, which would be an indication that the trend is starting to turn? The most recent swing low, because we've accelerated so much, is down here around 43.60. That's the low from mid-August. And I'm just going to take a moment and look at how far away that is. We have this great little percentage change tool. I don't mean to just fly through StockCharts, whether we click on annotate, go to the little letters here. These are all sort of the things, words and price levels and things that you can overlay, Elliott wave counts and all of that. If we would sell off dramatically next week, that'd be a 4.2% drop or so from the highest point this week to that swing low. So if we would come back and test that in the month of September, that would literally be probably the median, or it would by definition be the median. It would be about an average pullback so far in 2021. 4.5% is about the average of these four pullbacks that we've had so far. So it might be something to think about in terms of potential support if we would pull back. But again, lower high, lower low, breaking the 50-day. Those would be the three things that I would be looking for. The 50-day moving average, I think, is the most important one. That has been tried and true through the course of 2021. We have tested it a number of times, and every single time have bounced higher. So I think you can assume that the market finds support when it nears that level. I think a lot of people are focused on that, but it also tells me that when that level is broken, when a level has been tested many times and maintained support, that's encouraging. But if and when that breaks, I think you will find a flood to the exits as people recognize that the market conditions are now changing. So that might be something to look for going through this seasonally weakest part of the year. Talk about not weakness, but instead strength. I'll show you my main breadth chart, which is looking at the cumulative advanced decline lines. We have the S&P 500 at the top. We then have four AD lines. The advanced decline lines is a cumulative measure. So every day, how many stocks in these buckets close higher versus lower? That will give you a net change, and you string together all those net changes. You get this cumulative reading on advancers versus decliners. The S&P advanced decline line has remained bullish, in my opinion. It's been green this entire stretch for the last 12 months as it continues to make new highs and new lows along with the market. These others, starting in June, though, have not confirmed new all-time highs. So in June, July, August, you had a lower trend in the NYSE AD line, in the mid-cap line, and the small-cap line. Two of these now have started to break their recent swing highs, which is why I've now color-coded them subjectively back to the green bullish color. So a couple of these, the NYSE and the mid-cap breadth lines, have broken above their most recent swing high from earlier in the month of August. I think that indicates enough of a positive rotation to consider them positive. I'm still considering the breadth on small caps to be neutral, right? It's sort of range bound, lower highs and higher lows until we break above that swing high from early August. That will remain neutral for me. So interesting, the breadth conditions, which had been negative June into July, now rotating back to the upside, confirming the underlying strength that we've seen. We've seen more and more new highs on the S&P 500, more new highs on the New York Stock Exchange. This is looking at 52-week new highs and new lows. In my own process for market misbehavior premium members, Usually a couple times a week, I'll screen for stocks making new 3-month highs and lows. That's a little bit of a shorter term time frame, helps to capture some of the moves earlier on. This last week, I found 130 stocks in my universe of 10 billion and higher market cap, 130 names that made a new swing high on Wednesday. Only 7 made a new swing low. 2 weeks ago, it was even between buys and sells, or between swing highs and swing lows. So it shows you how much the market has changed just in the last couple of weeks. 7 out of 10 S&P 500 stocks are above their 50-day moving average. That is up from 32% in mid-June, which is certainly encouraging. However, that's a lot lower than 92%, which is where it was in April. So while a lot of stocks have recovered their 50-day moving average, that is certainly a net positive. It's worth noting that still a great many of them, 20% in fact, are still below their 50-day moving average, that assuming that were above there in April and now still below there. So it's not everything that is participating, but a lot more. And this trending higher would support the current bull market phase that we see. Still just under 70% of S&P names in a bullish signal according to their point and figure chart. So it's interesting that both of those breadth indicators remaining just below 70%. That's an interesting tell, and it shows you that it's just the cyclical sectors, it's consumer staples, it's the things that have been struggling a little bit, particularly on a relative basis, that are still in a bearish phase. But you really have to rotate higher to signal or to trigger a buy signal from a point and figure chart. That's not a leading indicator. It's more of a lagging indicator that would confirm a new uptrend has happened. And so it's illustrating that not everything is participating just yet. But what that tells me, there's potential. There's further potential upside as some of those stocks really start to participate. We reviewed sentiment in a little more detail yesterday, so if you missed it, go back to Thursday's show. But I would notice that the two things with the AAII survey is that it's back to net bullish over the last couple of weeks, which is overall constructive. Still only 43% of respondents are bullish versus bearish. And so that's not euphoric yet. That's not too bullish. I think that's sort of the healthy range, but I can't help but notice April into June into August, there have been less bulls every time the market makes new highs. Finally, just to highlight a couple of very brief ratios. First off, semiconductors holding in there. This is the relative strength of semis versus the S&P 500, breaking out of this sort of congestion pattern, now sort of range bound for the last 2 months. And I'd love to see if that ratio would be able to hook higher, which would confirm a resumption of the uptrend. I've heard a lot of discussion about small cap participation. While that is absolutely true, and the small cap index starting to show signs of life, still relatively weak confirmed relative to large cap stocks over the last 6 months. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.